Hello there. My name's John Maynard Keynes, and I'm going to introduce Professor Mark's weekly newsletter because I was a professor of economics at King's College in Cambridge. That was when I was alive. I also wrote a magnum opus, some people call it that. I would consider it the same thing, called The General Theory of Employment, Interest, and Money. Hopefully, you enjoy it if you read it, because I was a classical liberal thinker and at a very prestigious college.
All right, thank you, Professor. I appreciate you being with us this week. I would say Professor Keynes is one of the most important economists or economic thinkers that we've had. And ironically enough, the most famous thing, the thing he's most famous for is saying, in the long run, we're all dead. And I guess, like most other economists, you can't really argue at that point. So, anyway, we appreciate you joining us this week. And before we let you talk a little bit more about yourself and your philosophies and your theories, I just want to go over a couple of market principles that at the StockJobber.com we focus on. There are certain principles in financial markets that are always going to be true as long as we have financial markets. People try to come up with these elaborate well, I don't know if scheme is the right word, but these elaborate plans or these elaborate systems or these elaborate models to try to build a better mousetrap. And let me tell you something, people have been doing that since there have been markets. And no one's really been able to figure it out. So my experience after 2 decades trading in the institutional world and trading for some of the best money managers who have lived, Mary Gabelli and Steve Cohen, is that it doesn't need to be that complicated. We just really need to focus on these simple market principles. And one of the most basic ones is that some price levels are more important than others. So these levels are called support and resistance levels. So support is a level where there is more demand for the shares or more buy orders than there are sell orders. So if a market is trending lower, it's because the sellers need to offer their shares at a discount. They can't find anyone who's willing to buy at the current price because the trend is lower. So they offer their shares at a discount, and that causes the price to move lower. When we get to a support level, the dynamics change. There's enough buying interest or enough buy orders to absorb all of that supply, so things stop going down when they get to support levels. Resistance is the opposite. There's a lot of selling interest or shares for sale at a resistance level. When markets are trending higher, they are going up because buyers are forced to pay a premium in order to draw the sellers off of the sidelines. When we get to a resistance level, that changes. All of a sudden, there's enough supply to fulfill all the demand, and this price stops moving higher. So, these are the importance of these support and resistance levels can really remain intact for a long time, longer than you would think, years, months. I've literally even seen decades. And this is what we call market memory. And we're going to see that levels that were resistance can become support, and levels that were support can become resistance. And this isn't the be all and end all of markets, but I think if you understand these simple principles, levels, trends, and momentum, with some understanding of investment psychology, you can figure out how to make a trading model or system that works for you. One of the problems with all these modern trading schools and so forth and so on is that they try to teach some secret method, or someone says, oh, I got the secret, or blah, blah, blah. You just got to do what fits your personality. Everyone who's successful has their own way of doing things. It's not that they've copied someone else, but they've understood these principles of momentum, support, resistance, investment psychology. And by understanding them, it allows them to be once you get this understanding of the markets, it allows you to build systems or models that can be profitable. It doesn't need to be that complicated. We have all these AI funds or artificial intelligence funds that 5 or 6 years ago everyone was talking about, and since then the performance of these funds has been bad. And the reason why is because these funds don't factor in human emotions, or this data science doesn't factor in human emotions. It's all just based on statistics. And when we look at the market, we're not looking at people that are rational, and that's what AI assumes, is that people are rational, and obviously people are not. So we'll talk about that a little bit more, but let's just go to our next slide here. And this is our kind of just an overview of the markets. So I don't know. I think the markets are kind of confused right now. We have some good economic data, we have some bad economic data, but interest rates have dropped considerably, which should be good for the equities. There's probably going to be support around 390 for the S&P 500 or the SPY ETF if it goes lower. So understanding and knowing where these levels are is how we figure out where we place our trades and where to get in and where to get out. This is the S&P SPY, right? The S&P 500 ETF. And like I've said probably 100 times already, some price levels are more important than others. And as we can see here, for some reason, this 390 level for the S&P 500 ETF has been really important. Sometimes we know why, and sometimes we don't. But this level first became important back here in May. Notice how SPY was trending lower. Sellers had to sell at a discount. All of a sudden, when they got to the support level, there was enough buying interest or demand that the sellers could sell all they wanted to. Some of the buyers look around and sense that, oh, gee, there's other buyers in the market, so I better start increasing my prices, because if someone wants to sell, they're going to come to whoever has the highest price, or who's ever willing to pay the highest price. So that forces what we call an uptrend. Now, notice this, the market goes lower, and assuming the people that bought here didn't sell up here, a lot of the people who bought here are now going to have buyer's remorse. They're going to say to themselves, what was I thinking? I made a dumb mistake here. I shouldn't have bought it, so I'm going to get out of my position. But here's the thing, I don't want to lose any money, so I'm going to offer my shares out at the same price that I bought them for. And if I could sell them at the same price I bought them for, I can get out at break even. So this is a market dynamic. This is market psychology. Looking at charts is not tea leaves. Unfortunately, for a lot of people it is, because a lot of people that look at charts, and even some of the more well-known people you probably have seen in financial media or on CNBC or what have you, even they don't know what the hell they're talking about. They just regurgitate what they've heard. They don't understand these basic concepts of what looking at a chart should show you. I think I'm a little different because I didn't just learn from a book. I had years of actual real trading experience where I would have to use this stuff every day in order to do my job well. So here's the opposite. Notice how resistance becomes support. This is because people who sold, once the price moves higher, they regret selling, and they tell themselves, man, I made a mistake. I want to buy my shares back, but I don't want to pay more than I sold them for. So I'm going to place my buy order at the same level I sold at. And if there's enough of these remorseful sellers, the resistance can turn into support. Remorseful buyers turn support into resistance. Remorseful sellers turn resistance into support. And with a little trend within this little other trend here, we could see here, right? Support became resistance over here. So the support got broken. We rallied. Not surprisingly, hit resistance around 390. We finally have broken this level. This is an important level, but it's going to take a few days, if not weeks, to kind of see where we're going to go. I mean, if we look back here, this is like 2 weeks of trading. So we can't be impatient, but let's just keep an eye on this 390 level. I think as long as we're above it, and you're an intermediate term trader, it's kind of okay to stay long. Shorter term traders should probably look more around this 395 level, maybe 398. But this is just map of the market and something to give you just something to pay attention to. A good chart is like a map. It tells you where the market's going to go, right? If you're in town that you've never been in before and you don't have a map or you don't have a GPS, you're going to have a hard time figuring your way out around. So that being said, I see that Professor Keynes wants to come in and say something here. All right, Professor. I know you're an actual professor, and I'm not, but whatever. Let's hear what you have to say. And once again, thank you for being with us.
See here. Keynesian economics was named after that masterpiece of a book that I wrote, and I developed various macroeconomic theories and models, now of how aggregate demand strongly influences economic output and inflation. I believe that aggregate demand does not necessarily equal the productive capacity of the economy. Instead, it is influenced by a host of factors that affect production, employment, inflation. Professor Mark doesn't follow the same thought process as me because I am a classical liberal thinker, and he'll never be on the same level because we are, well, liberal.
All right, that was pretty interesting, as always. Here's something I just wanted to point out because it's a good idea of how simple a profitable trading model could be if you follow the right rules. So here we're talking about Bollinger Bands. And this red band or line is 2 standard deviations above the moving average, the 20-day moving average, and this green line is 2 standard deviations below the moving average. So why is this important? Well, and I should say it's the 20-day moving average. The reason why this is important is because if something exceeds this threshold, it's going to draw traders into the market. If it's above the threshold, these traders are going to be expecting a reversion to the mean, which means selling. And if it's below the threshold, these traders are going to be expecting a reversion to the mean, which means buying. And their actions in and of themselves could be enough to move the market. In other words, if they come in as buyers, they might force the price higher. If they come in as sellers, they might force the price lower. So this is an important thing to understand. And it's not just having the cool looking stuff on your chart here. It's about having rules and understanding how to use these things. For example, I wouldn't buy or sell just because we got above one of these levels. I would wait for it to reverse back within. And that's something that I explain in our trading lessons page over here. So hopefully you can sign up and learn a little bit more about how the markets really work and how to trade. This is our technology ETF, which is the biggest. Well, let me just first say that the S&P is made of 11 different sectors, and different sectors are more important at different times than others. Sometimes the technology sector is in charge, sometimes the healthcare sector is in charge. When we examine these 11 different sectors, it can kind of help us understand which way the broader market's going to go. Like, let's look at it this way, right? Say you saw like a really beautiful car that was really, the chrome was shining, it was really clean, it had a new paint job. You might think like, oh, gee, that's a great car. But say you open up the hood and you notice the whole engine is rusted out. Well, then that would kind of give you the insight that, well, maybe this car isn't so good. So sometimes by looking underneath the hood or behind the scenes or within these sectors, the 11 sectors that make up the S&P 500, you can get an idea for which way the broader market's going to go. And we could bring that to the next level down and figure out which way the ETFs may move. And the spiders are ETFs put out by State Street, which track these sectors. So right here, I see that technology is getting to a level that was important. It's overbought. It's above that Bollinger Band. That could draw sellers into the market. It's around a resistance level or a resistance zone, which is a level where there's a lot of sellers. So I'm not saying it's going to reverse, the market's going to crash or anything like that, but this could put a little bit of a top on it for the time being. Next sector here is our healthcare sector, and this doesn't get the attention it deserves because everyone's focused on exciting things like crypto and financials. Oh, how's that crypto working out? We'll have to talk about that. Boy, this thing is going to go into I think, a big contagion, and there's going to be a lot of different places brought down. I don't give advice specifically, but me personally, I would not have 1 cent put in crypto for now. And we could see here, look, here's an example of that market memory I talked about. Notice how this support level was intact for months. So in June, once this ETF got down here, there were enough buyers that they made a stand and they turned the tide. Same thing happened here in October. So sometimes these support and resistance levels don't convert. They stay intact for a while. They're only going to convert if they're broken, right? If this broke below it, then maybe it can convert. But up here, we can see the same thing, but on the opposite side. Resistance, resistance, resistance. So this is something we're going to be watching over the next few days. If we can't get through this, then that's a good chance, gives us a good sign that the market may move lower, like it did here and here. And when something doesn't get through resistance, the reason why they tend to make steep sell-offs is because just picture the old days when there was like a crowd on the floor of the New York Stock Exchange, and people would be trading, and maybe there's 50 people there, and it's going back and forth, and everything's great. But all of a sudden, the sellers notice that buyers are leaving the market, or new sellers are coming into the market, and they start to think, man, I better become more aggressive, because if I don't have the lowest price in town, the buyers are going to come to someone else, and I'm not going to be able to sell my stock. So they start undercutting each other's prices, and it causes like a snowball effect. And of course, the same thing happens on the upside. So that's why when things get in worn levels, they tend to make big moves. They either reverse or they break through. The opposite would be a breakthrough. This would be the buyers seeing, oh, gee, the sellers are leaving the crowd and new buyers are coming in. Maybe the tide is turning. Maybe now the bulls are taking over. So I don't want to risk this, so I'm going to raise the price that I'm willing to pay. I don't want my competition around here won't be willing to pay a higher price, because then the sellers will go to them and I'm not going to get anything done. All right, so the next sector we want to look at here is financials. And here's a good example of a market principle that is simple yet complex, yet, I don't know, you could discuss it with your finance professors or whoever, but I will just say that it's a principle of financial markets that when things are overbought and they get to resistance, they tend to sell off. So this was a resistance level back here for the financials around 35.80. So it's not surprising that we ran into resistance there again, because not only is it resistance, it's overbought. It's above this 2 standard deviation threshold. So if we start to trend lower, I got to stop saying so much. I'm going to write that right in front of me. So don't say so much. Sorry about that. I really hate when I'm listening to someone on TV or the radio and they keep going, this is their next sentence, So let's try not to say, All right, just kidding. Let's get back to this. Markets that are overbought and get to resistance tend to sell off because these conditions, we know there's already a lot of sellers around the 35.80 level, and we know that the overbought conditions draw sellers into the market because they're expecting a reversion, and their selling may push the price lower. If we do go lower, where do we look for a bounce or support? Well, around the 34.50 level. It had been resistance, and like we saw, levels that were resistance can turn into support because of seller's remorse. People who sold here thought they did a good job when it was lower. But once it goes higher, a lot of them regret it and they tell themselves, I'm going to buy it back, but only if I can get it at the same price that I bought it at. And I'd be willing to bet that many of the people that are listening to me right now have felt these same emotions. All right, so Professor Keynes over here is starting to say he wants to have some more stuff to say. All right, dude, come on, man. All right, well, whatever. All right, you can come on back on in, but just don't mock me because you're a real professor and I'm not. All right, so let's see what Dr. Keynes has to say.
Aggregate demand is volatile and unstable, and that a market economy often experiences inefficiency. See macroeconomic outcomes, a recession when demand is low or inflation when demand is high. That is why Powell and all these other idiots thought that inflation was a transitory and a good thing. They are committed to my theories, no matter how misguided by Barry Soetoro. They are committed. And Joe is a puppet.
All right, well, that was about as exciting as a wet towel, but I appreciate you being here. And one of the reasons why I wanted to bring out Keynes is because the people in the Fed are Keynes adherents, and that's why their fiscal policy has been so bad. Keynes, of course, don't forget, he was 100 years ago. And his idea was we focus on the demand side of the economy. In other words, what are the consumers doing? So in their view, if prices are going higher, it has to be for a good reason. It's because buyers are buying more. They don't consider the supply side, which means the amount of money that's out there. So Powell and Miss Yellen, they, in my opinion, have been focusing on the wrong things. And if you think that this is kind of ridiculous, well, after the markets blew up in 2008, the big commissions or whatever run by the government found that the reason why Alan Greenspan was so incompetent was because he was too much of an adherent of Ayn Rand, the person who wrote Atlas Shrugged. So don't forget, these are academics. They don't have the real world experience that it takes to really understand what's going on. But anyway, going back here to consumer discretionary, notice how clear this 135 level is. We got here, we rallied off of it. We see resistance become support. We've kind of run into resistance around here. So this sector looks kind of neutral, but it's a big sector, and for the market to make a significant move higher, it's going to have to clear this level, and time will tell. We have to let the market tell us what to do. We don't want to guess, but this is going to be one of the things that we're focused on this week. Here we have our financial sector. Actually, I'm sorry. Here we have our industrial sector. And kind of the cool thing with this chart is it shows you how psychological levels come into importance. Notice how this thing ran into resistance right around $100. Well, there's no reason for that from a purely logical mathematical standpoint. The reason why is because people say, hey, if it gets to 100, or if it gets to 100, I'll buy it. If it gets to 100, I'll sell it. Institutional traders, retail traders, humans just like to think in nice, clear levels. But here's something I would tell you. This is kind of important to think about because say you want to buy something at 50. Well, there's a lot of other people that want to buy it at 50. So instead of putting your order at 50, maybe you are willing to buy it at 50.25 or 50 and a quarter, which is what they said back in my day. So you get a little bit ahead of the line. But this is a really good example of a psychologically important level. And the same thing happened down here at the 95 level. If this thing moves lower, I would expect there to be some kind of support around 95 because resistance becomes support. Communication services, this is our sector where Facebook and Google live. Notice how I'm saying the wrong names. It should be really Meta and Alphabet, but I don't know. I think that's kind of stupid. But whatever. I guess my opinion is irrelevant. I'm sure Zuckerberg has a little bit more money than I do. And I'm just kidding because he has an unimaginable more amount of money than I do. But anyway, we can see resistance around 52. So if we keep moving higher, that's kind of where I'd be looking. If we move lower, I'd be looking back down around here, 46-ish. And that's a communication services sector. This is our consumer staples sector, which is testing a resistance level. Support. Gotta get this darn pen going again. Support becomes resistance. Resistance becomes support. So we'll see. We have to let the market tell us what to do. The market talks to us. And how does that happen? It happens by telling or showing us how these various markets react when they get to certain price levels. We can't just go, if you want to be a successful trader, you can't just go in and guess. You can't go in half-hazardedly. Is that right? Or half-hazardedly? Well, whatever, you know what I'm trying to say. You have to let the market tell you what to do. And the really good traders, the really good short-term traders, they show up every day with an agnostic attitude, and they're the ones who are able to switch on a dime. They can go from being bullish to being bearish. And here is Professor Keynes again. Okay, Professor, you can come back on now. Sorry. All right, here's Professor in the long run we're all dead Keynes.
So widely adopted after World War II, my theories had attracted plenty of criticism since they were introduced in the 1930s. The most famous guy, Milton Friedman, he was an American free market capitalist. He was a damn monetarist, I tell you. Friedman and his fellow monetarists thought the government could control economic stability by targeting the growth rate of the money supply. And they can control the money and the economy, right? Well, that is why you have inflation now, because the Fed did not pay attention to Milton Friedman and the monetarists. They paid attention to the Keynesian economic advice and force on government expenditure. The more money the government spends, the better off you are.
All right, thank you for that. Now we're going to look at our energy sector, which essentially follows in a lot of ways oil. So you can see here how a former resistance level became resistance again. Oil looks like it's kind of stalling out, so I would suspect to get some downside here if oil starts to go lower. But it's another example of how a level that was resistance in the past can become resistance again. Resistance can become support. So if this thing gets down to around 84.50, that's where we start looking for a potential buy or a potential rebound. And this is just the aggregate of the sector. What we can do, and if you subscribe to the sector analysis, we will look at which stocks in that particular sector are the ones that look like they're going to move the most. Here's our utility sector. We could be on the verge of a possible move lower because sometimes when you get things that look like this, it ends up becoming what we call a false breakout, where it looks like it's getting above a resistance level, but then it's going to get below. See with support back here. But we need a trigger. Just because it gets back below, it's not enough to get into the trade. I would say if we break these former short-term highs, that would be the trigger to get in. So this is on the radar screen, but I don't think it's an active trade yet. It's just something to keep on the screen there. I think traders should have things that are, their trading list should be stocks that are set up, meaning the They're either overbought, oversold. They look like they're going to make a move. And every trade idea should have a trigger, which means something that needs to happen in order for you to take the idea on. It's almost like if you're at a horse race or a NASCAR race, they say on your mark, get set, go. Well, on your mark, get set, that's your being set up. That's this kind of, well, it looks like it's a pretty weak thing. The go is if the trigger gets broken. And by having these triggers, it's going to just put the risk reward ratios much more in your favor. So I got this on the watch list for a possible short idea, but I think it's too soon to get into it now. Might be some good trades coming up here in our materials sector. This is where we have chemical companies, paper companies. Look at these Bollinger Bands. Each time over the last 18 months it's got up there, it's been a good time to sell. It was a good time to sell there. And this was an especially good time because we were overbought and at support. Overbought and at resistance. Support had become resistance. Now we're getting up there again. And now we even have what could be called an exhaustion gap. This happens because there's a lot of people who have been sitting on the sidelines that want to buy this, and they're just waiting to get a better price. So finally they say, all right, I'm sick of watching this go higher. I'm going to talk to my broker and buy it. And those are usually the last people to come to the party, so to speak. So overbought, at resistance, exhaustion gap, good chance that we go lower here. Real estate ETF, I'd kind of be expecting this to go a little bit lower. Reason why is because it's overbought. Notice it's above its Bollinger Band. It's at a former support level. It's a good chance there's going to hit resistance here. So it really doesn't need that to be that complicated. We don't need to have these, like, I'm building a better amount. Since the beginning of trading, people have been trying to figure out trading. And the problem is the vast majority of the people think it's too much like a chess game and not enough like a poker game. They think it's all about math. And chess is math, and the rules in chess never change. Poker is different. Of course, there are rules, but in poker, people have emotions. And when we're looking at a chart, we're looking at emotions. Think about it. What we're seeing here, this seemingly magical transformation from support to resistance, is buyer's remorse illustrated on the chart of a financial instrument. Ten-year yields have dropped significantly, so this is probably bullish for the market. So just this means we could get a pretty decent short-term move higher. Oh, I'm sorry, I'm getting a phone call here from Chairman Powell because he doesn't like how I was talking about how he sticks too much to Keynesianism. Let's see what he has to say. All right, Mr. Powell, what's up?
Hello, I'm James Powell. I'm President and Chairman of the Federal Reserve. Professor Mark thinks that I've done such a bad job on the economy. I'm also addicted to Keynesian economic theory. Now, while that may be for socialist countries, we are in fact pushing for a social agenda here in America, even though you are too dumb to know. In fact, he thinks that I am so dumb, I don't even know which way is up or down, hence the inverted image. What an ass. So, but that's what Professor Mark, who's not even an actual professor, who doesn't even have an actual government job that I get paid out of his taxes for. And it means I can't get fired, and if they try, I'm 67, so I'm going to sue them for ageism. So screw you, Mark. I got this shit in the bag. I win, boss. And until you figure that out, it's just going to be that way. Hey, J. Powell for the win. $55 million net worth there, Marky. Ha 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 ha.
All right, yeah, dude, whatever. Okay, whatever. You got 55 million. It's more than I got, so you win, but big deal. No one's going to remember me in 100 years as being incompetent. So why don't you put that in your pipe and smoke it? Let's keep watching these cryptos over the next few weeks. This whole Bitcoin, this whole FTX exchange and Binance and so forth. I think we're going to get a contagion and this is going to spread. And I would not have my money in crypto right now. All right, before we go here, this is just an overview of various principles that we look at. You guys can print this out, I guess, and study it. But we just talk about importance, price levels, we talk about momentum, and we talk about trends, and investment psychology. And that's the true secret to success. And I've worked with a lot of people over the decades, and the ones that are successful proprietary traders are the ones that have simple, logical strategies that are based on common sense. They're not doing things like Gann theory and Elliott waves. And here's me. I mean, not that I'm actually down on the floor here, because this was like, I think from the 1890s. So, I don't know if you believe in reincarnation. Maybe I was down there. But anyway, I have a pretty, as they say these days, deep resume. I worked for Gabelli. I worked for Steve Cohen. So I was fortunate to trade with two of the greatest money men. And I traded directly for them. I didn't just work at their company. So, whoops, I said so. So I'm going to try not to say so again. But I saw two of the best in the history of the industry, and I was literally shoulder to shoulder with them. I mean, not shoulder to shoulder, but I was within 20 or 30 feet of them. I was also the head of trading at 3 different institutional money managers. I've overseen the trading styles and strategies of everything from mutual funds to currency trading. I spent time as a market maker. When it comes to Wall Street, there's really not too much that I haven't seen. So that's why nothing surprises me. This whole FTX crypto thing, I'm not the least bit surprised. If you told me 5 years ago, oh, hey, one of these legends is going to blow up and be one of the biggest legendary disasters on Wall Street of all time, I would have said, oh, you mean there's a bunch of 25-year-old narcissists out there that think they're smarter than everyone? I wouldn't be surprised. Well, anyway, everybody, thank you for tuning in. Thank you, Dr. or Professor Keynes. And hopefully knowing where these levels are and what's important will help you have some insight into your trading this week. Thank you very much, and I hope to see you next week.